Hey, how's it going, everyone? My name is Amos, and if you're anything like me, then you appreciate a good deal and buying something high quality on a discount. So these are the dividend compounders I am actively buying right now. And as a reminder, this is what I think of when I imagine a dividend compounder with cheese. The only call out that I want to make is when we look at the first bullet point, I prioritize a net income more so than I do the revenue. And I'm going to explain why here in a little bit. So these are the four companies that I'm buying right now: Starbucks, UPS, McDonald's, and I know this one's icky. Trust me. Even I'm kind of like, oof, but yes, Papa John's. So three of the four companies that I'm buying right now are in the dining and restaurant category of companies in the US, with UPS being in the logistics and transportation sector. So why am I buying companies in the dining sector? If you haven't realized it by now, well, inflation has been slapping us across the face for the past 3 to 4 years. And as a result, more and more consumers are choosing to not buy a cup of coffee or a burger from McDonald's, and they're choosing more and more to cook at home to save a little money. Consequently, a majority of the companies that cater to consumers for their beverage and food needs, well, they're struggling for the most part. And there's other sectors that are also struggling right now. Off the top of my head, I think about the apparel industry, the retail industry, the medical devices space, a majority of the consumer packaged goods, such as Pepsi, General Mills. So there's a lot of industries and sectors that are struggling right now because Wall Street and big money is rotating out of those categories and putting it into tech or into CDs or into bonds or other safer alternatives. So for me, I see this as an opportunity to buy these companies while they're at their 52-week low, and for most cases at their 5-year low. I know it sounds stupid and cliche, but it really resonated with me when Warren Buffett said, when there's greed in the streets, you should be fearful. And when others are fearful, then there's your opportunity to be greedy if there's a good business on sale. So I'm going to be reviewing the three dining establishments together. That way it's a little bit easier for y'all. What you see on your screen right now is their revenue for roughly a little more than 10 years. So back in 2011, Starbucks posted $11 billion of revenue. And as we fast forward throughout the years, now Starbucks posted last year, $35 billion? And what about Papa John's? Papa John's isn't as big as Starbucks and isn't as readily available as Starbucks. However, Papa John's is also seeing a good trend with their revenue growing in the right direction. 2011, they posted $1.2 billion. And as we fast forward throughout the years, as of last year, now they posted $2.1 billion. Very slow, but it's steady and it's consistent and going in the right direction. However, when we look at the right side of our screen, which is McDonald's, look at their revenue. This is where it gets interesting and where I want to explain and go into depth. Back in 2011, they posted $27 billion of revenue, right? But as we fast forward throughout the years, look what's happening. Sometimes it stays flat, and sometimes it's going down. And as of last year, they posted $25 billion. So what's the deal with McDonald's? Isn't this a terrible company on the basis of revenue alone? Wall Street and analysts care more about profits and future margin expectations. So for me, I like to look at the top line, which is called the revenue, because I want to know if the company is growing or not in a general sense. But Wall Street looks at it on a deeper angle. And that's why, although McDonald's revenue is pretty much flat for the past decade or so, it's a darling of Wall Street, except for the past 52 weeks. They have been increasing their margins almost every single year since 2011. And there's many different ways to increase profit, right? Such as cutting costs, optimizing the headcount, inflating menu prices, or shrinkflation. McDonald's operates a franchise business model, meaning they depend more so on fees they collect from their franchisees rather than just relying on raw revenue numbers. So even though McDonald's is a restaurant company, I think of them as a real estate enterprise because not only do they own most of the land that their restaurants are on, but they also own the buildings. And as a result, they're able to charge rent to the franchisees and have land asset in some of the most expensive places in the world. So McDonald's has an appreciating asset in places such as New York City, Tokyo, Berlin, any major city you can think of around the world. And the net net income is what investors refer to as the bottom line. And when we look at Starbucks, it went from $1.2 billion to now $4.1 billion. Papa John's, it's slowly going. It's going. Their net income went from $55 million to $82 million. And as we just talked about, the net income for McDonald's is a different story, and it looks good. Bottom line, it's been increasing almost every single year. So $5.5 billion back in 2011, and now basically they're at $8.4 billion. That's why Wall Street likes McDonald's. Are they growing their dividend year over year? For these three companies, the answer is yes. And is the payout ratio below 90%? Yes. And is the dividend yield a decent number? And it looks like yes for all of them, with Papa John's being the highest at 4.4%. And when we look at their performance for the past 10 years or so, from January 2015 to June of 2024, with $10,000 invested back in 2015, that would have grown to $22,000 for Starbucks, and for McDonald's, $34,000. Starbucks would have grown your money by 9% year over year, and McDonald's would have grown your money just shy of 14% year over year. So when we look at their performance in the span of 10 years, it looks pretty good. But here's where it gets a little hairy and a little ugly. When we look at the performance for Papa John's in the past 10 years and compare it to Domino's using the exact same variables and timeline, your $10,000 after 10 years would have turned into $9,700. Whereas on the other hand, if you had just invested into Domino's, that $10,000 would have transformed into $60,000. So what the heck is going on with Papa John's? Well, their total return for the past 10 years has been atrocious because in the past couple of years, since the end of 2021, their stock has been getting hammered. As a matter of fact, they used to trade for about $133 a share in December of 2021, and since then, it's just been downhill. So if they were trading for $133 and we pulled that 10-year total return, then it would have looked more like Domino's performance. But because they're going through a sticky mess right now in the past 2.5 to 3 years, the stock looks worse than it actually is. So when you look at the story, you know in the past 2.5 years, they lost almost all of their gains that they should have had because of the macroeconomic conditions and inflation. But if we zoom out beyond 5 years or even 10 years for their total performance, Papa John's total return for 20 years has been 524%. As you can see, it should have been like right here. This mountain peak right here should have been like right here. But because of inflation and everything else that's going on, they lost almost all of their gains, and now they're trading for about the same price they were back in 2014. And that's why sometimes it's good to zoom out and look at things from a bird eye's point of view to have a sanity check. Like, is Papa John's as disgusting as it looks right now on surface level? When we zoom out in 20 years, it looks okay. They're just going through a pickle. And then when we look at the technical indicators, it confirms our beliefs and our hypothesis. Their relative strength index, which is the RSI for the past 2 years, is sitting at 18, whereas normally their RSI is around 40 to 70. A relative strength index is basically a measurement of how much the stock is being bought versus sold. So it's a gauge of whether or not it's being overbought or oversold. So a general rule of thumb is 50 means it's average. Anything above 70 is it's being overbought. And anything under 30, it's in the territory of being oversold. And so an RSI of 18 for Papa John's tells me that people are just overreacting and jumping ship when it comes to Papa John's. And to confirm that, if we zoom out to 5 years, even during the pandemic sell-off, it did not go as low as 18, because even for the 5-year calculation, the technical indicators tells us that the RSI is still at 18, because during the pandemic sell-off, it was probably somewhere around 35 to 40 as their RSI. So to see it at 18 today, it tells me that the company is a dumpster fire or an opportunity in disguise while everyone else is fearful. And when we look at their forecast and valuation for the future, the fair value price target for Papa John's is $69 a share. And they're currently trading for about $40 to $41 a share. Their 5-star price, meaning super good bargain, is when it's under $41.40. According to Morningstar, Papa John's is a screaming buy on the basis of their stock price. And when we benchmark this price target to another website that has all the different price targets from analysts, well, they also say the price target for Papa John's is $69, with a high price target of $90 a share and a low price target of $45 a share. They're currently trading for $40.90, which means they are absolutely undervalued to the guy who does not believe in Papa John's at all and places a $45 price target on them. And then when we look at UPS, their stock price is also going through a sticky hot mess right now because back on Tuesday, they reported their second quarter earnings and it was way below analyst expectations. And as a result, the stock price went down by over 13%, which is their worst day on their stock market record. And the reason being is that their margins dropped by over 30% year over year. And that's because around the world, everyone is kind of hurting right now with their wallets and finances because UPS is seeing a lower demand for shipping goods. However, it's not all doom and gloom with UPS because look at this statement, right? From the CEO. As expected, our operating profit declined in the first half of 2024 from what we reported last year. They already forecasted this last year saying, hey, things are about to get sticky for us. And to clarify, going forward, we expect to return to operating profit growth. The earnings per share came in at $1.79 a share. The expectation was $1.99. That's a pretty big miss. And the top line was $21.8 billion, falling short of the $22.1 billion that Wall Street expected. So they missed by $1 billion. Now, here's why I think Wall Street is overreacting. The forecast for the rest of the year, the revenue in aggregate is going to be around $93 billion, down from their previous forecast of $94.5 billion. What I'm trying to say is, if they were like, hey, I think our revenue is going to come in around 70 billion or even like 65 billion, then I would be absolutely concerned. But understanding the macroeconomic conditions and knowing that this is not going to last forever and revising the forecast by only $1.5 billion, I don't think it's the worst thing. Granted, I'm thinking with an optimistic lens. I know. And when we look at UPS's performance in comparison to FedEx, with $10,000 invested in January of 2015, it would have grown to $16,000. With FedEx, it would have grown to $19,000. The call out that I want to make is that, once again, similar to Papa John's, if we were to pull this 10-year total return back in like 2021 when UPS was doing all right, then it should have been closer to like $25,000 or $30,000. But since the end of 2021, UPS has been going through a downhill trend. But if we zoom out and look at their 15-year performance, the total return since the recession, then it's 277%. As you can see, after this time period right here, UPS has just been going downhill because inflation started to be an issue, which ultimately led to their profit margins being decreased. But prior to this inflation ordeal, UPS was growing at a slow and steady rate, very consistent. And then during the height of the pandemic, when everyone was doing e-commerce and online shopping, they exploded. Since then, they have been dropping because everything is slowly returning to normal, except the inflated prices. So is UPS a disgusting company? Let's go from left to right. What you see on the left side of your screen right now is their top line, the revenue. Back in 2011, they posted $53 billion in revenue. And as we fast forward throughout the years, UPS has been trending in the right direction. However, from 2022 to last year, they did drop by $10 billion in their revenue because now we know that inflation has been eating away at their profits and a lower demand in overall shipments being flown around the world and traveling through their logistics network. And when we look at their net income during the pandemic, look at this, $12 million, $11 billion, and then as of last year, their bottom line was reduced by 50% year over year. And when we look at their free cash flow, best case scenario, you want to see it grow every single year. The second best thing is to see it be consistent or stable, which is funny because in 2011, they posted $5 billion in their free cash flow. And as of last year, now it's $5.2 billion. So relatively flat, but that's way better than a negative free cash flow or decreasing in the wrong direction. So as of right now, as I'm filming this video, UPS is currently trading for about $128 a share. And according to Morningstar, their fair value valuation is $150. A bad deal for buying UPS is when it's $202 a share. A fantastic, fabulous deal is being able to snag UPS at under $105 a share. So their fair valuation is in between these numbers, and they're currently at $128, so they're roughly undervalued. And when we benchmark it to another website to see the price targets from all the different analysts, well, they say UPS is worth $152 a share, a high price target of $195, and a low price target of $100 a share. So in a hypothetical sense, if I had $100, I would be putting $70 towards Starbucks and McDonald's, because honestly, that's a no-brainer. These are dividend compounders with cheese, just going through an over-exaggerated sell-off because Wall Street is concerned, and inflation being the downfall of these two companies. But going forward, 5 to 10 to 15 years from now, Starbucks and McDonald's is going to be absolutely okay. So with that $100, $70 would be split even between Starbucks and McDonald's, and I would put $20 towards UPS because honestly, UPS is a decent dividend compounder with cheese. I'm not going to say it's delicious, but it's also not disgusting. This is a very average dividend paying company. These two right here are fantastic. And then that brings us to Papa John's. With Papa John's, out of that $100, I would probably allocate $10, maybe even $5 towards them because it is risky. It's a gamble in the short term, but in the long run, I genuinely think Papa John's is going to be okay. And instead of a long-term investment, with Papa John's, I'm going to hold until it hits about $70 to $80 a share, and then I'm going to sell out of it. And the reason being is that the better and more superior pizza company is Domino's. But in the meantime, I'm just going to enjoy the dividends that Papa John's will pay me as I wait for them to get back up there in valuation once all of this inflation ordeal is finally over. And to be fully transparent, I bought into Papa John's, I think like maybe 2, maybe 3 shares at about $40 each. So between you and me, I'm not sweating too hard here. Do they have the chance to go down even further? Yes. But do they have the chance to rebound? Yes. If they go down to like $35 or even $30 a share, it's going to suck, but I have the patience to wait it out. Which brings me to the other companies that are on my radar right now for one reason or another. It's not that I'm trying to buy into them, but I'm curious and I'm observing what's happening with them. Anyways, I want to close out the video by saying do not be discouraged. The important thing is time in the market usually tends to be on our side. So if you're invested into a solid company with good operations, more likely than not, things are going to be okay in the next 10 to 20 years. But if the company is not profitable for the past 10 to 20 years and their finances have been shaky consistently, then what you're doing, my friend, is called gambling. And that's why, for the most part, I think people are probably better off just investing into VTI or VU and calling it a day. That way, they don't have to risk it with individual companies. And on that note, I want to be transparent and say this. I invested into 3M once I realized that they were oversold a couple years ago. And everybody was selling out of 3M for good reasons, right? Their revenue was inconsistent, they had a bunch of litigation problems, and their future looked really bad. And as for me, once I looked at their finances and their economic moat with most of their products, I realized that I had an opportunity. Yes, it was risky. Yes, it was a gamble. So I had to patiently wait for their turnaround story. And sure enough, this past week, they finally posted good earnings and their stock price just went up by over 20%. And I am so relieved to say I am finally in the green with 3M. It took forever. It felt like forever, but it feels good to finally be profitable with my 3M holding. And as a reminder, we're so close to hitting 3,000 subscribers. Once we hit 5,000, I promise I'm going to start working on that life story video. And once we hit 10,000 subscribers, I'm going to be posting weekly portfolio updates and telling you guys what I bought or sold or how the portfolio is doing overall. I'm just really excited because the numbers and the data is showing me that this channel is growing. So thank you for being a part of this community and growing movement. And until next time, stay safe and I'll talk to you really soon, my friend.